Hello, everyone, and welcome back to Blu Ventures. So, I know it's been a while, but we're back and stronger than ever as today kicks off a special two-part mini-series with Rajiv Mehta, who's a managing partner at Blu Ventures, which is a venture capital firm investing in early-stage technology companies. Rajiv has worked with countless startups and student founders and brings a sharp eye for what makes a venture fundable and what doesn't. In this first episode of the two-part mini-series, we'll dive into what it takes to not just launch a startup in college, but to fund it, scale it, and build it into something real. We'll break down what VCs like Rajiv actually look for in student founders, the biggest red flags he sees, and how young entrepreneurs can stand out in an increasingly crowded space. If you've ever wondered what separates the college startups that fizzle out from the ones that raise money and grow, this episode's for you. All right, enough said. Let's jump into part one of this two-part series with Rajiv Mehta. Hope you all enjoy. Rajiv, thank you so much for being on Dormer Ventures. I really appreciate it. This is a very highly anticipated episode. Actually, for our listeners, it's going to be a two-part mini-series focused on, per the title, two perspectives in VC. We'll go more into that later, but thank you so much, Rajiv, for being on.
No, I appreciate you, Zach. Thanks for having me, man. Happy to help out. I know we had a couple conversations here recently, so yeah, I'd love to be able to give back and kind of give my perspective, hopefully to help out some future founders, some future VCs.
Definitely. And like you just mentioned, those two different sort of archetypes that have to do with in entrepreneurship and venture capital kind of represents very well what we're covering with this two-part series, right? The first part is going to be focusing more on student founders. So a student that's building something, how can they build something fundable and gain investor attention? And additionally, what are the most important things a startup needs to stand out from the lens of a VC such as yourself? And then the second part will be more about the VC career path. So students that are looking to go into VC, what are the best things they can do now and how should they follow through with the next steps to ensure that they can land the best position in VC and see if that's the correct career path for them in the first place. But yeah, so this first episode is going to be really about the first part for founders, which is the large majority of our listeners, how to fund and scale your startup as a student. But before we go into that, I want you to talk a little bit about yourself. How did you get into venture capital? And tell us a little about, Blu Ventures.
Yeah, I think if you talk to most VCs, there really is no traditional path into venture capital. And I think that holds true for myself. I started off, I got into this space, pivoting from a career in financial services and wealth management. I used to work in a wealth management space, helping my individuals and helping clients and families, build generational wealth for the most part. I was a certified financial planner, so I really love getting into the numbers and being able to make sure my clients can achieve their goals and really helping them out. And a few of them had their own businesses that we were looking to potentially sell, and so that was my first exposure into being on the private market side, looking to sell some of the small businesses either to the local family offices or to like smaller PE firms. So I sat on the same side of the table as them, negotiating with the buy side. That was really interesting, and that really kind of piqued my interest of working in this space. Fast forward, COVID comes around. Everyone kind of had that epiphany, trying to, I think it was the Great Resignation is what they call it. I decided to make a little pivot, pursue my MBA, and so I can make a career change, which is what led me to Washington, D.C. and to Georgetown University, where I obtained my MBA, and that was my first exposure into venture capital. There was a national competition called the Venture Capital Investment Competition that a few of my friends and I, kind of participated in, which gave me my first exposure to what it's actually like being a VC. You have a mock $100 million fund, and you look at three real startups. You sign an NDA and everything, and you're actually pitching to actual VCs in this space as to which of those three startups you'd make an investment in, why, what are the pros and cons, and why you didn't choose the other two. And it was a very quick, rapid competition, but that kind of clicked the light bulb for me of this is the space I want to be in. I'd love to be at the forefront of innovation, work with founders, help founders, and be in this space. So, fast forward a couple internships later, I had the opportunity to, come on board with Blu Venture Investors, which is where I'm at right now. Blu Ventures is an early stage cybersecurity, B2B SaaS, and health tech firm here based in the Mid-Atlantic, the DC area. What's interesting is they started off as an angel group about 15 years ago. A lot of former entrepreneurs, former C-suite level executives turned investors, and that group grew larger and larger, and they eventually raised institutional funds, to where we're at today. So what's unique is that a lot of the angel investors still stick around as actually really active core partners, and they provide unique perspectives just given their massive background, their network, and what they've known in different industries. So it's really powerful when we're making investments to have expertise and guidance with some of these partners in the background, and it's very fulfilling because you're seeing, especially now with the forefront of innovation with AI and LLM and just being in the cybersecurity space, it's never a day that repeats itself, I would say.
Hmm. And that's very represents a huge chunk of what VC is. At least from my very shallow experience, you'll never have a day that's the same as the other. So that's amazing. And going into kind of the main gist of what this first part of the episode is, the whole idea of how to fund and scale your startup as a college student, I wanted to use some of that experience and your perspective that you just mentioned to start off by talking a little bit about specifically what makes a student startup stand out, right? So, from your experience as a VC, what are the top traits or even behaviors you look for in successful student founders?
Yeah, that's a good question. So I would say the first thing is really having a clarified thought of what you're trying to solve. From a startup perspective, I think the most successful startups aren't trying to create a startup just for the sake of building and scaling and exiting. The thesis of your startup is really you identified a problem and you're passionate about this problem and you would do anything it can take to find a solution or work towards a solution. And that can come from experience in a specific industry or just having exposure to a certain problem and identifying that there is a gap here and the current processes are either inundated or antiquated or it's just not up to time and you want to be able to resolve that issue. And so identifying that first and really being passionate about it is something that I think a lot of student entrepreneurs can find a lot of success in when that's the backbone, because that gives you a lot of drive and motivation. The motivation shouldn't just be I'm looking to get a 20x exit. It should be that I see this problem and I want to fix it. And then again, diving into that a little bit further, just kind of backing up on the founder, with that passion also has to come, I would say, coachability. A lot of things when you're going through a startup process, you're going to get thrown a lot of obstacles. You're going to get a lot of wrenches thrown in your way. You're going to see your idea get shot down. You're going to probably pivot. But it really kind of puts a backing in the coachability and the perseverance in the founder, how you're able to change, how you're able to pivot, and how you're able to take criticism and sometimes feedback and adapt that and be able to grow from it. I think a lot of successful founders, really utilize the advisors and the coaches and the mentors they have around them. And that can also come from VC as well. They'll be very, critical and it's very, very scrutinizing, I would say. But at the end of the day, it's all for the success of the startup, right? And so, not being too resistive, not being too defensive, but understanding, where you have room for improvement and being able to understand what you know and know what you don't know, and being able to utilize the resources around you to get you where you need to be. I think that'll lead you to success.
That was a really good point, especially, the coachability aspect. From my personal experience, when I first got into the startup scene, the first ever pitch competition I was a part of, like you said, VCs, investors, even the judges at that competition, right? They were very, very critical. And unfortunately, like many other student founders, when you start a startup, you think you know everything, right? You don't know what you don't know, as they say, and as you said. So instead of seeing it more in a humble lens, I went off and thought to myself, they don't know what they're talking about. But as I grow, I realized that being coachable is so important. And another fantastic point you mentioned was, knowing, having an actual purpose and a drive towards what you're looking to solve and for your drive to be something you're trying to solve rather than an exit you're trying to achieve, right? A lot of student founders, once again, that I see as a major pitfall is that they go into things looking at the exit. The whole glamour of having a successful startup and, having all this revenue and gaining massive loads of VC investment, you know, you'll get to that, but it's really focused on, like you mentioned, having that initial purpose and drive. So on that topic of the founders themselves, I want to know, right, we've been talking a little bit about the idea. How much does the idea itself matter versus the team that's executing it?
From a early stage perspective, I would say we probably invest in people more than we do an idea. Um, the idea, especially in the early stage, is going to pivot. It's going to change. And that kind of goes back to the previous point of the coachability, the adaptability. But what you're really looking at it from a people perspective is, do you believe in the founder? Do you believe in their vision? Do you believe in their leadership? If they can convince a VC or an investor to invest in them, there's a good chance it can probably convince people to join their team. And who you surround yourself with as far as, engineers or a sales team or whatever you need, to be able to get yourself to get scalability and to get growth, that typically falls on the founder or the founding team. Um, Especially probably at the student level, your team is going to evolve. So is the idea. Things are going to change. They're going to adapt. One thing that we look at Blu Ventures when we're looking at a founding team is this concept of a hustler and a hacker. So the hustler, from the founding team is someone that really knows go to market, really knows sales, the strategy, and where they're trying to go and where they want to drive the startup to. The hacker is someone that really has that deep technical expertise, understands the product, understands like the engineering background of it, and really understands how to get this to where it needs to go. And that necessarily doesn't have to be the same person, doesn't necessarily be two people, but I think within that founding team, if you have that combination, you can see a lot of potential success with that.
Fantastic. So the hustler and the hacker, I love that. That makes it really easy to envision what makes a good team. And focusing and diving more into that and the team in general, we talked about, within that team, you're focused on coachability and humility and people that are passionate. Beyond that, going more into maybe the red flags that you see both in a team and the startup itself, what are some common red flags that would make you personally or your team or your firm, more cautious about an investment?
And is this from a team or a founder perspective, or like an entire startup in a whole?
Like an entire startup. So you as an investor, when you're looking at a startup, what are some major red flags that you tend to see that would make you more hesitant directly relating to the team itself?
Yeah. So, one I would say is a clear definition of a definition and differentiation of what you're trying to be and what you are. It's kind of cliche, but there's this like moniker, like you're saying that, oh, we are the blank for this. For example, if you're creating a startup, you would say that, oh, we're the Uber for college universities. And like, okay, well, how does that really make sense, right? So you dive a little bit deeper into it. If you can easily within like one or two sentences, find, like, you call it an elevator pitch, really capture an audience of like, this is what we're trying to do. And this is why we need to do it, and this is what our differentiation is. If I'm in a pitch meeting and I'm 25 minutes in and I'm still like, I've heard a whole bunch of buzzwords, but I really don't know what you're doing. And if you can't capture, me or another investor in that time frame, then you probably, it's not to say that your idea is bad or wrong. It's just your framing or the way that you're positioning it needs to probably change. In addition to that, it has to be a clear, like, competitive mode. There's this other, moniker as well. When you're looking at a startup, is it a vitamin or is it a painkiller? I'm sure you probably heard that before, but that the essence of it is this idea something that's nice to have, or is this something that I need to have? Is it really going to alleviate the pain of a big problem that's in this marketplace? Or from a vitamin perspective, is this something that it's good to have, but if I don't have it, we'll manage it. We'll figure out a way to get around it. And so, when we're looking at a company and you really don't see that, oh man, like, this thing could really make a big difference. Potentially a red flag, maybe a little more of an orange flag. Maybe stuff needs to be shelled out. And I would probably say lastly is the market. I think sometimes a lot of founders can either overstate or understate the market that they're playing in. Whether that's the total addressable market or the market that's obtainable for them, really being, I would say, honest to the space that you're trying to hit and where you're trying to see that, or as far as disruption of where your startup can be. I think if that's not very clear, or if, you're trying to, I think I'm going to hit you with all these other catchphrases and monikers that I've heard with. It's like you're trying to boil the ocean rather than trying to, like, boil a pot of water. I'm pretty sure I butchered that, but you really have to identify, what part of the market is going to be your bread and butter.
Definitely. And that part you mentioned about in terms of looking at your market and, setting up what you can actually capture in more of an honest form. I wanted to dive a little bit into that because I see that a lot of student founders you'll see in their pitch decks or when they present, they kind of identify their kind of capturable market as their total addressable market. What do you think about that? And, how much sort of time should founders be spending on actually making these, projections in terms of their addressable market, their revenue, their growth, in the next few years? What's your whole idea on how founders should go about doing this sort of work?
Again, only from an early stage perspective, those numbers are they just don't really hold that much truth because they can't. Especially if you're starting a company and you either are pre-revenue, have 6 months of revenue. If I'm looking at your projections, of course your projections are going to be overstated, right? Of course you're going to be probably looking at, double-digit growth. You're looking at, seeing your revenue, 3x, 4x, 5x. Because if you're not putting that in your slides and you're not a believer in your own product, then there's something's wrong with you at that point. So, if I would say from an investor standpoint, whatever your projections are, we're automatically slashing it in half. How you're looking at the market, we'll test it. I am that person. If I look at your slide deck and I see your market number there, one, you better have a source on the bottom left or the bottom right. I'll dive into it. I'll click on that source and double check it and fact check it. But then I'll use my like resources and what I'm seeing in this space to double check. Like, okay, where are you getting this massive market size, or how are you building it down to this, or help me understand your math. And if it makes sense, it makes sense. But I'll certainly question it. And then at the end of the day, you're from a revenue and from a growth standpoint, you can find a lot of comparables. It's depending on the industry that you're in. Like if you're a SaaS company or if you're a CPG company, you can see what the industry trends are and you can see where the market is moving. You can use that as a frame of reference. But at the end of the day, there's some things that could be out of your control. Like, for example, if you created something in a CPG space at the end of last year, and now come the beginning of 2025, you not in, once in your mind you think about tariffs being an issue, and then when these things happen, well, that's out of your control, right? So your projections are already probably slashed, or now your costs have risen up, and you don't know what's going to happen in the future as well. So you can have these projections, that's perfectly fine, but I'll try to be honest with it. Don't overinflate it, and like I said, it's probably going to be cut in half by the investor that you're talking to.
Definitely. I think that's a really, really, really important point. I'm glad that you bring that. It's nothing that I even thought about until now. So we've kind of been, as of now, discussing more of the side of through the VC perspective, what makes a startup stand out or successful. I want to now jump more into funding and scaling as a student founder, right? So my first question in this sort of space is, from your perspective, when should a student startup really start considering raising from outside investors and VCs?
Yeah, so I'll probably try to summarize what I was taught from. At one point, he was my professor, but now is someone I work with here at Blu Ventures. Professor Jay Gamble is what I call him. He taught a phenomenal class on building entrepreneurial ventures, and one of the first things he talked about is how VCs are in comparison to startups and founders. And VCs are rocket fuel. So if you're a startup and you really have a good understanding what your go-to-market is, how you're going to scale and how you're really going to hit the ground running, VCs can give you that rocket fuel to hit what we like to call as hockey stick growth and seeing those revenue numbers, double, triple, quadruple in a short time frame. On the other side of that spectrum, though, if you aren't really solidified, if you don't know, where your go-to-market is or where you're trying to go, and you start up getting VC funding, that rocket fuel is going to make you implode. Because from an investor perspective, once you start getting VC money, now the clock starts ticking. The investor needs, a decent rate of return. You need a great multiples. You have your IRR, clock starts ticking. And so they're trying to see revenue and growth fast. So if you're not prepared to be able to hit the ground running or have a clear track in mind, I would argue, avoid trying to get VC and or equity funding until you really have a clear path. Because there are many different alternatives that can help you as far as providing some capital and giving you a little bit of breathing room. Looking at non-dilutive funding through grants, through pitch competitions. I would also look at potential like state funding opportunities. The state of Virginia has great opportunities with VIPC, and the state of Maryland as well. If your startup, hits certain parameters, and your team or certain other parameters are, utilizing, and also like founded in the state, and your team is in the state, you can get some decent amount of funding from them as well. And so I would definitely try to utilize that. Again, from a student founder perspective, you're probably not banking off of a former exit that you've done or a large pool of capital, but that's okay. What you need to do is utilize the non-dilutive funding to really test out your idea, really hit the ground running so that when you are seeking venture money, you have a clear path and you know exactly where you're going.
Definitely. And that advice you give towards, you know, when to seek VC investment, would that same advice apply towards something like a family and friends round? Because I hear about family and friend rounds a lot. However, you know, there's kind of different takes I get. Some people say it's a great way to get early capital without, being restricted. But other people say, it's very dangerous since you're managing close relationships with money involved. What's your thought process on that?
I've heard the term with one more F added to it. It's called family, friends, and fools to an extent. Or, yeah, you are taking a big risk trying to support someone you're probably close to in their venture and in their idea. I think it's just necessary. Like if I'm trying to build something, you go after the low hanging fruit, the people that you think will be able to support you, no matter what. And honestly, if you're a family, friend, or fool investing in this space, you are probably investing with the mindset that you're not going to see this money come back. So I would just treat it just like you're going to the casino and gambling. I'm putting in the money that I'm okay losing with, but at the same time, I'm banking on, this person, either potential loved one or someone I'm very close with, and I want to see them succeed. So that's why it's probably easier to reach after that low hanging fruit. And you're probably finding people that are experts in this field. If you're building like an AI SaaS platform, and if I go to like my parents or that one rich uncle, he may not know that space really well, but he trusts me and he loves me, so I can get that funding from him. So yeah, go after the low hanging fruit. Use that, but use it wisely. Try to be able to get any free help, get volunteers, get students that are really passionate or knowledgeable in this space to be able to help and work with you, for free, so that you can really be strategic with the money that you've, raised and put that either towards, building out your MVP and building out and doing R&D as well. So that once you get to the place of, you know, getting that venture growth and getting additional capital, you can say that you've done it very lean, and you can say that, we've only raised X amount to date, but we got so far ahead, we just need a little bit more to get us to where we need to be. Because I've seen startups that have raised, millions and have not a cent in revenue because they've just built and pivoted and built and pivoted. And I'm not to say that's good or bad, but I've also seen companies that, have taken hundreds of thousands and have quickly and rapidly built and scaled and started generating revenue because they're very strategic in what they were doing, and they realized that they can get really far really quickly with limited resources, but now when they need to get to a scalable size, they need a lot more funding. And that's probably a better story to tell.
Got you. No, definitely. And so, kind of wrapping up this section of this set of episodes, just going over some final takeaways and advice. What's one piece of advice you'd give to a student founder trying to stand out to investors?
That's a really good question. I would say as a student founder, you got to show passion and you got to show conviction, and it's more of a show. Like, don't just tell. Bring valid traction, bring a valid market map, really have deep customer insights, and really know the space that you're operating in. And I think a lot of that comes into you being hands-on. And I've taken a couple entrepreneurial classes where just building out an idea, just as far as testing, you're just going out in the field and just getting feedback, like just walking up to customers, asking people like, would you like this? Do you see this as a problem? Do you think that you would use this? And you got to be scrappy, and you got to be not afraid to get shut down and get a whole bunch of rejection. But that really just shows how gritty and how the perseverance that you can demonstrate. And I think that shows when you're talking to an investor. So yeah, I know it's probably a little bit a lot, but I think show, don't tell is probably the easiest way. Don't talk about what you've done. show what you've done and back it up with the numbers and help the investor understand, why they should take this, potential risk in you and why there's a lot of conviction there.
Definitely. Awesome. So showing, don't tell. That's fantastic to all our listeners. So for all of our listeners that, may choose to only listen to this episode, as a final remark, where can they follow your work and stay connected with you?
Yeah, I'm a weird one. I don't have a lot of social media outside of LinkedIn, so that's probably the best resource. Um, I'm happy to, reach out to people or have them reach out to me, and I'm always available to be a resource. So, feel free to reach out to my LinkedIn, Zaki. You can share it at the end of this. Send me a connection request, send me a message. I'm always happy to give back.
All right. That wraps up part one of our mini series with Rajiv Mehta. Before we wrap up, here are a few key takeaways from my conversation with Rajiv that you definitely don't want to forget. First off, VCs are investing in people, not just ideas. In the early stages, what matters more isn't a flashy pitch deck, it's you. Your clarity around the problem you're solving, your coachability, and your willingness to pivot when needed. As Rajiv put it, the most successful startups aren't trying to create a startup just for the sake of building and scaling and exiting. The thesis of your startup is really that you identified a problem, you're passionate about this problem, and you do anything it takes to work towards a solution. Second, VCs are rocket fuel, not magic, right? Venture funding won't fix broken systems, it'll only amplify them. As Rajiv put it, if you aren't already solidified, that rocket fuel is going to make you implode. VC funding accelerates everything, and with that acceleration comes pressure, expectations, and a ticking clock. So make sure your foundation is strong before pouring on the fuel. And finally, show, don't tell. As a student founder, your story matters, but so does your traction. Rajiv said it best: don't talk about what you've done, show what you've done. Come to the table with real data, real customer insights, and real conviction. That's what turns a pitch into a partnership. All right, that's all for this part one of this mini series. Make sure to tune into part two, where we flip the script. Rajiv shares his personal journey into venture capital and walks through what it really takes for students to break into VC themselves. Trust me, you won't want to miss it. All right, I'll see you all there.